as investors worry about the latest round of tariff announcements, maybe this war footing and so forth. But there's another concern maybe you can take off the list or push down a little bit. My next guest says inflation is slowing way more than the markets think. Let's bring in Matt Miskin. He's the co-chief investment strategist at Manullife, John Hancock Investments. Matt, it's great to see you. And this is precisely the moment. You just heard Jimmy and others have talked about this. Like, is the hard data going to start to move more in an inflationary direction? So I find it interesting you're taking the other view here.
Yeah, and Kelly, we're really focused on housing market right now. And it's odd to us that the Fed really doesn't focus on housing. Housing is the biggest driver of inflation. If you look at the CPI index, it's nearly 35% of the index, and yet you never hear them talk about it. I actually watch your show, Kelly, a lot, and you bring in housing experts. It's awesome because the housing market often leads the economy, and it's the biggest driver of inflation. We are seeing the housing market change dramatically right now. Housing inventory is spiking. So houses for sale are coming on the market at a fast pace. The amount of write down on prices are significant. We had March and April outright housing declines in national home prices. And so if that continues, that's going to drive down inflation. And yet the Fed seems to not notice it or pay attention to it. And frankly, the bond market isn't either.
Well, there's
let's just
dwell on the housing thing for a second, because there's about 8 tentacles that could, kind of 8 different ways of looking at this. I'm just kind of curious. So yes, weaker home prices, maybe that means weaker rents. And if so, weaker core inflation, hugely important. But then you read, record high rents in New York City, not the greatest example, fine. But like, what's happening on the rent front is an important question. Also now, Matt, that so many people own housing and bought at high prices, every time home prices fall now, I have to imagine that's a wealth hit on some trickling down to a consumer space. And maybe to your point, that's contractionary and deflationary. But just kind of how do you kind of think about all of that?
Yeah, so the rents in New York City are up. The Northeast is actually holding up the best. And the Northeast, no one came to the Northeast during COVID and was like, oh, yeah, I want to go up to the Northeast and be cold. And, they all went other places, whether it was Florida, whether it was Colorado, whether it was the West Coast. And that's where the housing market really accelerated more so. So it's the hottest markets that are rolling over. The apartment markets, they already had been decelerating in terms of rents. It's like 1% right now on a year-over-year basis. Rent inflation isn't so bad, but the wealth effect is huge, to your point. And this is the biggest thing I think that people are missing on tariffs. Tariffs can create a negative wealth effect because consumers could balk at it. And if the corporation is picking up the tab for the tariff, that's a hit on margins. This is Q2 earnings season's coming right up. Right. And I can't wait to really go through this on company by basis. But if that weighs on margins, how do you deal with that? Well, you got to cut costs. What's the biggest cost for most corporations? Employees. So we have to watch here to see if there's a negative wealth effect that overwhelms the inflation. Yeah. And if that does, then the Fed is way off sides here and should be cutting more aggressively.